When I worked as an IRS revenue agent, there were certain red flags that almost guaranteed we'd take a closer look at your return. Now, let me be clear, a red flag didn't always mean you'd be audited. But when those showed up, they raised questions. And in the IRS world, questions can easily lead to an exam. Today, I'll walk you through the 5 biggest red flags I saw in my years as an agent, and more importantly, how you can avoid waiving them in the first place. Before I dive in, let me remind you of something important. I worked small business audits. I wasn't sitting across from the big corporations with tax attorneys. I was meeting with everyday business owners, Etsy sellers, landscapers, electricians, food vendors, one-person shops. The IRS knew these returns carried risk because small businesses often mix personal and business funds, or struggle to keep books at all. That's why we were trained to spot certain patterns. And here's the tone I want you to remember. Red flags aren't the end of the world. They're warnings. They're signals to the IRS that something deserves a second look. If you understand them, you can prevent most of the problems before they start. The very first red flag we looked for was mismatched income. As an agent, my first step was always a minimum income probe, comparing the income on the tax return with the information the IRS already had on file. That included W-2s, 1099s, and other forms reported by third parties. If the return said $60,000, but the 1099 showed $85,000, that was an immediate issue. It didn't mean fraud. Sometimes it was a bookkeeping error, sometimes deposits were misunderstood, sometimes it was a timing difference. But either way, the burden fell on the taxpayer to explain the difference. Many audits were selected in the first place because of mismatches like this. The IRS's computer system is designed to catch them. By the time the file landed on my desk, the discrepancy was usually one of the key issues I had to resolve. How do you avoid this? Reconcile your income every month. If you sell on Etsy, Shopify, or use Stripe and PayPal, make sure what hits your bank account ties out with what you're reporting. Don't wait until tax time to figure it out. The second red flag was expenses that didn't fit the size or nature of the business. In the IRS, we call these LUQs, large, unusual, or questionable items. Every case came with a classified issue sheet. That was a list of deductions or line items the reviewer thought needed special attention. It was my job to dig into them. And I'll tell you, certain categories popped up again and again. Meals and entertainment. If they were disproportionately high, that was a LUQ. Vehicle deductions. If someone claimed 100% business use of their personal car, I knew that was unlikely. Home office deductions. If the size or type of the deduction didn't match the business, it went on my list. Here's a simple example. If a taxpayer reported $40,000 in gross receipts but claimed $20,000 in meals, that didn't pass the smell test. Until receipts and explanations proved otherwise, that expense sat under a microscope. The key here wasn't that the expense was automatically disallowed. It was that it had to be substantiated. And until it was, it stayed a red flag. This one surprises people, but it's a real factor. Your lifestyle has to line up with your income. If you reported $30,000 in income, but you were driving a luxury SUV, taking international vacations, and living in a high-end neighborhood, it raised questions. Could that lifestyle really be supported on what you claimed? The IRS doesn't audit people because they own nice things, but when the lifestyle on display doesn't match the return, it becomes a target for inquiry. And here's where the inside perspective matters. We had access to tools like Accurate. That meant we could see assets tied to a taxpayer, vehicles, property, sometimes even business affiliations. So it wasn't guesswork. If the return showed low income but Accurate showed multiple homes and new cars, that was a red flag that needed answers. How do you avoid this? Pay yourself properly from your business. Keep your personal and business finances cleanly separated. And if your taxable income is legitimately low, be prepared to show how you're covering living expenses, whether through savings, loans, or spouse's income. Another major red flag was repeated business losses. One loss in a year, that wasn't unusual. Small businesses struggle, market shifts, things happen. But when a taxpayer reported losses year after year, that's when the IRS started asking questions whether it was a true business or just a hobby. Here's the standard we worked with. If you show a profit in 3 out of 5 years, the IRS generally accepts that you're a business. But if you keep reporting losses 5 years straight, it triggers questions about profit motive. I saw this more often with activities people love doing: crafts, horse breeding, even photography. They poured money in, but never turned a profit. If all the returns showed were expenses with no income, the IRS had to ask, is this really a business or are you subsidizing a hobby with tax write-offs? The fix? Show your effort. Keep records of your marketing. Document your time spent. Track your attempts to grow. All of those things prove you're operating with the intent to make a profit, even if the numbers haven't caught up yet. The final red flag didn't appear until after records were requested, but when it showed up, it changed the game. When I sent out an information document request, what came back told me a lot. Sometimes it was neat, organized, and complete, but other times, it was a shoebox of receipts, incomplete statements, or documents that didn't add up. Messy or missing records created two problems. They slowed everything down. If I couldn't follow the trail, I had to keep asking for more documents. And they sometimes forced escalation. If the taxpayer didn't provide what was requested, I could issue a summons directly to the bank. And here's the bigger issue. If I found problems in 1 year and that same questionable pattern appeared in prior or subsequent year returns, I had the authority to expand the audit. What started as 1 year could turn into 3 or more. The fix? Simple systems, monthly reconciliations, receipts stored digitally, a clear ledger that ties out to bank activity. You don't need fancy software. Even Excel works. What matters is being able to show your numbers back up your return. So let's recap the 5 big red flags I saw as an IRS revenue agent. 1. Income mismatches, when your return didn't match the IRS's own records. 2. Expense LUQs, large, unusual, or questionable deductions that needed proof. 3. Lifestyle versus income, return showing one number, lifestyle showing another. Yes, we had tools like Accurate to check. 4. Repeated losses. Too many years without profit made the IRS question your intent. 5. Messy or missing records. Disorganized or incomplete documents led to summonses and sometimes expanded audits. Every one of these issues made audits longer and more stressful, but every one of them is preventable. Here's your 3-step checklist to keep yourself clear of most red flags. 1. Reconcile income monthly. Make sure what hits your bank matches what you'll report. 2. Keep expenses reasonable and documented. Save receipts. Note the business purpose. And 3. Separate business and personal. Use dedicated accounts so there's no confusion. If you can do those 3 things, you're already ahead of most of the taxpayers I audited. In this episode, we talked about the 5 biggest red flags that triggered audits. But what happens after the IRS sends that first letter? In the next episode, I'll take you inside the audit room so you know exactly what to expect, step by step, from first contact to closing. So remember, red flags don't guarantee an audit, but they do increase your risk. The good news is that most of them are completely preventable if you keep clean, consistent books. If this was helpful, hit subscribe and check the description for free resources that will help you avoid these mistakes and feel confident in your numbers. Clean books, less stress, zero fluff.